Script title: Financial Accounting Key Terms and Definitions. Full Vocabulary Guide. Approximate runtime: 10 minutes. Intro. Hey everyone, welcome back to the channel. If you have been following along with our financial accounting playlist, you already know that each chapter builds on the one before it. But here is the thing. If you do not have the vocabulary locked in, the concepts start to feel like a foreign language. You might understand the math but miss the meaning entirely. Today we are doing something a little different. We are pulling together 15 to 20 of the most essential key terms from all 16 chapters of this financial accounting course, giving you a real-world example for each one, and organizing everything into themes so your brain can actually store this information in a useful way. Think of this as your master vocabulary guide. Bookmark it, come back to it, use it before exams. Let's get into it. Theme 1. The Foundation. What accounting actually is. Let's start at the very beginning with the terms that frame what accounting even does. The first term is accounting. Accounting is the process of identifying, recording, and communicating financial information about an organization to decision makers. Think of it like a scoreboard for a business. A small bakery owner uses accounting to know whether they made money last month or spent more than they brought in. Next is the accounting equation. This is the backbone of all financial accounting. Assets equal liabilities plus equity. Every single transaction in accounting comes back to this equation. If a coffee shop buys a new espresso machine using a bank loan, their assets go up and their liabilities go up. The equation stays balanced. Assets are resources owned by a company that are expected to provide future economic benefit. Your car is a personal asset. For a delivery company, its fleet of vans is a major asset. Liabilities are the obligations a company owes to outside parties. A mortgage on a building is a liability. The company received value now but must pay it back over time. Equity, sometimes called owner's equity or stockholders' equity, is what remains after liabilities are subtracted from assets. It represents the owner's claim on the business. If you own a food truck worth $50,000 and owe $20,000 on a loan for it, your equity in that truck is $30,000. Theme 2. Financial statements. The reports that tell the story. Now let's talk about the main reports companies produce. The income statement reports a company's revenues and expenses over a specific period of time, showing whether the business earned a net profit or suffered a net loss. A retail clothing store would use its income statement to see if it made more money selling clothes than it spent on rent, employees, and inventory. The balance sheet is a snapshot of a company's financial position at a single point in time. It lists assets, liabilities, and equity. If you looked at Apple's balance sheet on December 31st, you would see everything they own and everything they owe on that exact date. The statement of cash flow shows where cash came from and where it went during a period. It breaks down into operating, investing, and financing activities. A startup might show negative cash flow from operations, but positive cash flow from financing, because investors just put money in. Revenue is the income earned from a company's primary business activities. For a law firm, revenue comes from billing clients for legal services. Expenses are the costs incurred to generate that revenue. The law firm's office rent, staff salaries, and software subscriptions are all expenses. Theme 3. The recording process. Let's move into how transactions actually get recorded. A journal entry is the formal record of a financial transaction in the accounting system. Every time something happens financially, a sale, a payment, a purchase, it gets captured as a journal entry with a date, accounts affected, and amounts. When a gym collects a monthly membership fee, the bookkeeper records a journal entry showing cash received and revenue earned. Debits and credits are the two sides of every journal entry. Debits increase assets and expenses, credits increase liabilities, equity, and revenues. This is one of the most misunderstood concepts in accounting. A debit is not simply a subtraction. It depends entirely on the type of account. When you buy office supplies with cash, you debit office supplies and credit cash. A ledger is the master collection of all accounts a company uses. Think of it as a binder, where every account, cash, rent expense, accounts receivable, has its own page tracking all activity. The chart of accounts is the organized list of every account name and number used in that ledger. Theme 4. Adjustments, Cycles, and Controls. Adjusting entries are journal entries made at the end of an accounting period to update account balances before financial statements are prepared. A company that pays 6 months of insurance upfront needs an adjusting entry each month to recognize just 1 month of that expense. Without this, expenses would be understated. Accrual accounting is the method where revenues and expenses are recorded when they are earned or incurred, not when cash is exchanged. A contractor who finishes a project in December but gets paid in January records the revenue in December under accrual accounting because that is when the work was done. Internal controls are the policies and procedures a company uses to protect assets, ensure accurate records, and prevent fraud. A restaurant requiring 2 employees to count the cash drawer at closing is an example of an internal control. These are critical. Companies lose billions every year to fraud that better controls could have caught. Theme 5. Assets in depth. Accounts receivable represents money owed to a company by its customers for goods or services already delivered. A wholesaler that ships products to a retailer and sends an invoice is carrying that amount as accounts receivable until payment comes in. Inventory refers to goods a company holds for sale or uses in production. For a car dealership, all the vehicles on the lot are inventory. Managing inventory carefully affects both the balance sheet and the cost of goods sold on the income statement. Depreciation is the process of allocating the cost of a long-term asset over its useful life. A company buys a $100,000 piece of machinery expected to last 10 years. Rather than expensing the full amount immediately, they record $10,000 of depreciation expense each year. This matches the expense with the revenue that asset helps generate. Theme 6. Liabilities and ownership structures. Current liabilities are obligations due within 1 year. Accounts payable, money owed to suppliers, and short-term bank loans are examples. Long-term liabilities are obligations due beyond 1 year, like a 30-year mortgage on a company building or bonds issued to raise capital. Bonds payable are long-term debt instruments a corporation issues to borrow money from investors. When a city issues municipal bonds to fund a new highway, investors buy those bonds, and the city promises to repay the principal plus interest over time. Finally, let's define partnership and corporation, 2 key ownership structures. A partnership is a business owned by 2 or more people who share profits, losses, and responsibilities. A law firm with 3 partners is a classic example. A corporation is a separate legal entity owned by shareholders. Unlike a partnership, shareholders in a corporation have limited liability. They cannot lose more than their investment. When you buy a share of stock in a company like Nike, you are a partial owner of that corporation. Closing and call to action. All right, let's bring this home. We just covered 18 essential terms, from the accounting equation all the way to corporations and bonds, and we grouped them by theme so these ideas stick together the way they actually connect in your textbook. Here is the honest truth. The students who do well in financial accounting are not necessarily the best at math. They are the ones who understand the language. When you know what accrual accounting means, the adjustment chapter makes sense. When you know what equity is, the whole balance sheet clicks. So here is what I want you to do right now. Go back to the individual chapter videos in this playlist. Watch Chapter 1 again with these definitions fresh in your mind. Then Chapter 2. Use this video as your reference guide whenever a term trips you up. If this helped you, hit the like button. It genuinely helps other students find this content. Subscribe if you are not already, and drop a comment below telling me which term confused you the most before watching this. I read every single one. We will see you in the next video.